Hey everyone, and welcome. We're about to jump into a really important question about your financial safety net. If you ever had to rely on disability insurance, would you also get a tax bill? It's something a lot of people wonder about, and the answer, well, it might not be what you think. So let's get into it.
Just picture this for a second. You're hurt, you can't work, and you finally start getting those disability benefits you've been paying for. It's a total lifeline, right? But then, tax time rolls around, and bam, a surprise bill from the IRS. This is a very real possibility, and understanding why is absolutely crucial for your financial planning.
Okay, so here's the key. The secret to understanding this entire topic comes down to one simple fundamental rule from the IRS. I like to call it the one-time tax rule. Basically, the IRS is only going to tax the money involved once. They'll either tax it on the way in, when you're paying premiums, or they'll tax it on the way out when you're receiving benefits. But here's the important part. They never, ever tax both. This one idea is the Rosetta Stone for this whole subject. And here's how that rule plays out in real life. It's like a fork in the road, super simple. If your insurance premiums are paid with pre-tax dollars, that's money that hasn't been taxed yet, then any benefits you get will be taxable. But if you pay those premiums with after-tax dollars, the money left in your paycheck after taxes are already taken out, then your benefits come to you completely tax-free. It's always one or the other. So, here's our game plan. We've just covered that core rule. Next, we're going to see how it works with your own individual policy, and then we'll dive into the much more common situation, insurance you get through work. We'll also touch on a few government and business policies, and then we'll wrap up with the most important part, how you can figure all this out for your own policy. All right, let's start with the easiest one to understand, a disability policy that you go out and buy for yourself, totally separate from your job.
This is our one-time tax rule in its purest form. When you buy your own policy, you pay for it with your own after-tax money. Since that money's already been taxed, you don't get a tax deduction for the premiums. The IRS already got its cut on the way in. So what does that mean? It means if you ever have to collect benefits, every single penny comes to you 100% tax-free. Simple as that.
Okay, now we get to the one that applies to most people, and this is where it can get a little more complicated. For most of us, disability insurance comes from our employer, and when your job is involved, there are a few more moving parts.
With a group plan at work, there are really four main ways the premiums get paid. Your employer could pay for the whole thing. Or maybe you pay for it through payroll deductions, either with pre-tax or after-tax dollars. Or in a lot of cases, it's a mix of both. The cost is shared. And how it's paid? Well, that changes everything.
To make this crystal clear, let's walk through a really common setup. Let's meet Joe. His company provides a basic disability plan, but Joe decides he wants a little more protection, so he pays a bit extra to boost his coverage.
Okay, so let's say Joe's employer pays the full premium for a benefit that would pay him $1,000 a month. The company, of course, treats this premium as a tax-deductible business expense, so the money going in hasn't been taxed.
And since the employer got that tax break on the premium, the IRS is going to get its share on the way out. So if Joe gets disabled, that $1,000 a month he receives is considered taxable income. He's got to pay taxes on it. But remember, Joe wanted more coverage, so he opted to pay a little extra himself, and it came right out of his paycheck as an after-tax deduction. That extra payment buys him an additional $400 a month in benefits.
And here is the other side of that coin. Because Joe paid for this chunk of the benefit with his own after-tax dollars, that extra $400 he gets every month is completely 100% tax-free. The IRS already taxes money on the way in, so they don't get to touch it again on the way out. This quote from the source material really just sums it all up perfectly. For Joe, he's getting $1,400 a month total, but only $1,000 of it is taxable. That tax-free part directly matches the share of the premium that he personally paid for with his after-tax money. All right, let's just quickly touch on a few special cases you might run into. These are things like Social Security or specific policies for businesses. And even though they have their own unique rules, you're about to see they follow the exact same core principle we've been talking about. Just take a look at this chart. Social Security benefits, they can be taxable. It just depends on your other income. Workers' comp, usually tax-free because your employer pays for it. And for those business policies, it's the same logic. If the premium is a deductible expense, the benefit is taxable. If the premium is not deductible, the benefit is tax-free. See the pattern? It always comes back to that same one-time tax rule. So after all that,
What really matters now is bringing this all back home. How does this actually apply to your personal finances and your own sense of security? We've gone through individual plans, group plans at work, and even some of those special cases. But for you, right here, right now, it all boils down to one single critical question.
That is it. This is the one question you need to find the answer to. When you look at your paycheck, are the deductions for disability insurance coming out before taxes are calculated or after? The answer to this one thing tells you everything you need to know. And the good news is, finding the answer is usually pretty straightforward. The first place you should look is your pay stub, or dig into your employee benefits package. It should say right there if the deduction is pre-tax or post-tax. That tiny little detail makes a world of difference.
And that brings us to our final and maybe most important thought for you today. Once you figure out whether your benefit is going to be taxed or not, take another hard look at your coverage amount. If you just found out that your benefit is taxable, is the money left over after taxes still going to be enough to cover your bills? It's a really crucial calculation, and it might just change how you plan for the future.